Hey everyone, and welcome back. It's day 3 of our 50-day journey into the stock market. Today, we're going to tackle two of the most powerful and honestly most misunderstood words in investing: bull and bear. I mean, you've heard these phrases, right? They're everywhere, on the news, all over Twitter, and of course, from that one uncle in the family WhatsApp group who's suddenly an expert. But here's the thing. While everyone loves to throw these terms around, most people don't really get what they mean. And for a new investor like you, that little bit of misunderstanding, it can be a very, very costly mistake. So let's cut through the noise. What is the real deal here? Because trust me, understanding this is absolutely fundamental to making smart moves with your hard-earned money. Okay, let's dive right in. It's actually way simpler than it sounds. Time to properly meet the two big animals of the market kingdom. So here it is side by side. A bull market is all about a sustained uptrend. And that word sustained is super important. It's not just one good day or a good week. We're talking about a consistent rise over weeks, months, even years. A bear market, you guessed it, it's the total opposite. A sustained downtrend where fear just takes over and all the news headlines get pretty scary. And you know, these markets have a whole vibe to them. In a bull market, the feeling is just electric. Optimism is everywhere. It feels like you can do no wrong. A company could report so-so news and the stock still goes up. Everyone you know starts to feel like a stock-picking genius. The bear market vibe, on the other hand, is just gloomy. Pessimism is in the air. You'll see amazing, solid companies, stocks you know are good long-term bets, and their prices are still falling. And what do most people do? They hit the panic button and sell, often right at the bottom. Now, knowing the definitions, that's the easy part. The real trick is avoiding the psychological traps that each market sets up for us. This is where people really get into trouble. So, trap number 1 happens in a bull market. You've heard the saying, a rising tide lifts all boats, right? Well, that's a bull market. When everything is going up, it is so easy to start thinking you're a genius. But a lot of the time, it's just the market itself doing all the heavy lifting for you.
But the bear market trap, this one is even more dangerous. Fear kicks in. Every instinct in your body screams, stop putting money in, it's just falling. But if you look back at history, the absolute best opportunities to build long-term wealth happen right in the middle of that fear when everything is basically on sale.
Okay, let's get into a slightly more advanced idea, but it's something most people completely miss. And getting this really separates the amateurs from the pros. See, markets never, and I mean never, move in a perfect straight line either up or down. They wobble. They take a couple steps forward, then one step back. And it's during these wobbles that investors get totally faked out. For instance, inside a big multi-year bull market, you'll have these things called corrections. The Nifty might suddenly drop for a few weeks, and everyone starts panicking, thinking, oh no, it's over. But usually, it's just the market catching its breath before it starts climbing again. And the opposite is true too. It's called a bear market rally. Right in the middle of a nasty downtrend, prices will suddenly shoot up for a few days. It gives everyone this false hope, right? They think, phew, the bottom is in. They start buying back in, only to see the market fall even further. So the big question is, okay, how long do these phases typically last? Now, we can't predict the future, of course, but we can look at the past to get some really useful clues. Looking at the history of the Indian markets, a pretty clear pattern shows up. Bull markets, the good times, they tend to last for years, think 2 to 5 years on average. But bear markets, they're usually much shorter and sharper, often lasting between 6 and 18 months. And those wobbles we just talked about, they're even quicker, usually just a few weeks long. And this is a really, really critical point about our own psychology. Bear markets are shorter, but man, they feel so much longer. Why? Because fear is a far more powerful and intense emotion than greed. A year of losing money feels way more painful than a few years of making money feels good. So, what's the big takeaway from all this? What are you actually supposed to do with this knowledge? Well, the answer might surprise you. Your job is not to predict the future. You don't need a crystal ball to tell you when a bull market will end or a bear market will begin. Honestly, even the top experts get that wrong all the time. Your real job is much simpler. Just recognize the environment you're in right now. You just need to know which game you're playing today. Because the rules of the game have changed completely. In a healthy bull market, a strategy like buying the dip works beautifully. But if you try to buy every single dip in a bear market, you can get seriously hurt. Sometimes the smartest move in a bear market is just to be patient and hold more cash. The strategy has to fit the season. Okay, let's start to wrap this up and look ahead. We've talked about markets going up and markets going down. But what happens when the market pretty much goes nowhere? Well, there's a name for that too. It's called a sideways market, or my personal favorite, a kangaroo market, because it just kind of jumps up and down without going anywhere. And no, I'm not making that up. It's a real term. It's a whole different kind of challenge, and we'll definitely be covering that in a future session, so stick around for it. So I'm going to leave you with this question. Based on everything we just talked about, the numbers, the vibes, the psychology, take a look at the Nifty today. What do you think? What kind of market are we in right now? Is it a bull, a bear, or maybe something else entirely? Think it over, and I'll see you tomorrow for day 4.